What's going on YouTube? This is Rajan here for Average Traders. And today we're going to go discuss, we've started the earnings season, always gets kicked off by the banks, and we're just going to go through, some of the major news, some of the movement, the earnings that happen with the banks, and we're going to later on have a look at, what's coming ahead, and Jason's going to talk about Tesla and their upcoming earnings, which is actually coming on Wednesday after the close, so that's going to be really good. Tesla's had a great move recently. It's up like 15% in the last week. So there's a lot of anticipation ahead of this earnings, ahead of their good Q3 numbers. So let's crack on and let's look at some of these bank earnings. And JPMorgan did kick off the show. They did report. They reported a Q3 adjusted EPS. Now, a lot of these banks, they still are, some of their loan loss reserves are, they're being adjusted. So they have credit for a loan loss reserve adjustment, and that's pushing up their EPS numbers. So when you see some of these numbers, some of them, it's hard to tell how much they actually beat for unless you look through the whole PR and then you look at, what some of them say, okay, the EPS was 25 cents was added for this particular reason, et cetera, et cetera. But for JPMorgan, we X'd out all the items and we had an EPS of $3.03 on revenue of $30.4 billion on a managed basis. And the thing is, JPMorgan always are strong, but this was just an ever so slight beat. But they did show good strength in their investment banking unit, showing 7% growth year on year. And all of these banks, I noticed that their equity division was strong, but their fixed income part of the earnings, most of the banks saw a decline on a year on year basis. But obviously last year we had a situation where there was a lot of the federal loans given out as part of the pandemic program. So obviously, we're going to see not as much because these banks were cleaning up on those fixed income fees that they were making last year. So this year, obviously, most of these banks are going to show a year-on-year decline. But with Citigroup overall, we saw average loan growth, which was up 5%, which was pretty good. That's despite the overall trend of most of the earnings, where we actually saw loan growth actually declining or being fairly flat, but JPMorgan did show growth in their loan growth. And if we look at what they did, so initially you can see this was the initial reaction, to that number. So what it was just a slight beat. JPMorgan trading near or at all-time highs. And then we just saw, a slight move lower from 163 down to about 160, but then gradually, we've had two really strong days at the end of last week, and even today we have another strong day on the Nasdaq, while the Dow is slightly mixed. But buyer just stepped in, and then JPMorgan just traded higher with the banks, and it also was aided by the fact that we've had some continued strong tapering expectations, which is helping steepen the yield curve, and a steeper yield curve helps a lot of these banks. So we've seen, the general rise in JPMorgan, and at the end of close on Friday, we finished at 166, considering we hit a low in the week of just under 160. And if I look at now at JPMorgan, probably still trading around 166, 166.47. So JPMorgan, as they usually do, solid set of numbers, nothing like to write home about, but we had a good move. We moved up about 3% on JP, and pretty much what you expected. Bank of America, on the other hand, had a really good move. They reported EPS of 85 cents. That's a 14-cent beat based on the estimates. Revenue of 22.8 billion, also a strong beat. And their trading revenue, as I was saying, 9% gain. Investment banking revenues, just like JP, pretty strong, up 23%. Their fixed income, commodities, and currency division, their FIC, was down 5%, for the reasons I was telling you before. But as you can see, this equity part of the earnings was very strong, up about 33%. The loan growth up marginally, probably about 1% on the total loans and leases, while the average loan balance in the business segment was up about 8%. So we had pretty solid numbers there for Bank of America, and you can see the movement since they reported on October the 14th, which was the Thursday, and we pretty much moved from 43.50 to all the way to 46. So there was about a 7% move there for Bank of America. It was strong off the earnings, I think, which was around this time maybe. And then we had a dip into the open, and then we've just pretty much been one way. And again, it's been aided by the overall sentiment of higher rates, steepening yield curve. And so we've had a pretty strong move on Bank of America today, pretty much flat. So we're still trading roughly about where we did on the close on Friday. So after that, we had Citigroup, another one, reported strong earnings. Again, I'm not sure how clean that EPS number is, but on the headline, we had a 215 beat of 182 estimate. Revenue was also slightly ahead on an adjusted revenue basis, but on the flat revenue is more or less in line with estimates, and their loans were flat. And again, we've seen a similar sort of thing. Fixed income trading was, I don't actually have the decline here, but it was slightly declined. But the institutional client revenue and global banking revenue saw mixed fortunes. The banking revenue was down 14%, and the institutional client revenue was up 4%. So it was pretty solid numbers from Citigroup, and out of all the banks, the most flat. I think they reported, I believe, on the Friday morning, and we had a move higher and pretty much just settled down for the rest of the day. And then, so prior to earnings, we were trading at just above 71, so we're about $1 higher. So barely a 1% move. So I'd say with Citigroup, it was, as you saw, the loan growth was flat. We had mixed results in some of their divisions, but they did report a top and bottom line beat. So pretty decent there. For Wells Fargo, this was an interesting one because they reported an EPS of $1.17, which was a beat on the headline, and revenue, which also beat. But they did, as I mentioned earlier, $1.7 billion was added to earnings due to decreasing the allowance for credit losses. So that added the 30 cents, and then take away the 5 cents on the impact of operating loss associated with the September 2021 enforcement action. So I'm not actually sure if this number includes this taken off or not, but either way, initially, off the back of the number, we did see Wells Fargo actually show a bit of weakness. Their loans were flat quarter on quarter, and year on year was down 8%. But you'll see what happens. So on the earnings, this is what we had. We had this move lower from around 40, just over 46.50. We went down to 45, pretty much went flat. And on Friday, we just had a monster rally where Wells went up almost 6%, over 6%. And so despite those pretty mixed figures and the initial not great reaction, I think we closed down the day on the Thursday 3%, and then on the Friday we had a big move higher, 6.5%. So Wells Fargo did end up the week almost close to 5% higher, and from the lows up over 6.5%, 7%. So there's a lot of mixed trading action there for Wells Fargo, but again, the headline numbers were a beat. And Goldman Sachs, can I say, they blow it out of the park every quarter. Last quarter was an absolute blowout, and this quarter, well, pretty much the same thing. They reported $5 beat on the top line, on the bottom line, and the EPS was, the top line was over a $2 billion beat, which is massive. So, they're showing strong loan growth as they continue to, I think through their markets division, getting into a bit more of the retail banking side. Their investment banking revenue, huge growth year on year, 88%, phenomenal for quarter on quarter. And that's despite their mad quarter last quarter, they still showed 3% growth. And Goldman Sachs is one of those where every division, they're pretty much, on the global markets front anyway, they reported 8% growth in their FIC division, and their global markets overall saw a 23% rise in revenue. So it was very strong on that front. Asset management did see quite a sharp decline quarter on quarter, but pretty much most of the other divisions showed good growth. Consumer and wealth division up 16%, 35% on a year-on-year basis. So it was strong. Goldman Sachs, as you can see, it was pretty, they reported on Friday, so it was running up into these earnings. And then on their earnings, they just continued to move higher, and we closed up above that 400 mark. And in fact, Goldman Sachs is the number one performing stock in Dow Jones. It's up over 50% this year. So, with numbers like that, it's not really surprising. And, the banking sector has been on fire lately. And then we see it right here. So, today I think it had another strong day on the Monday, up another 1.8%. So closed at 413. So Goldman Sachs, no stopping it, $140 billion market cap. And the final stock, we'll go on to is Morgan Stanley, another primarily investment bank, which seems as of late always to beat. And again, they beat again 204. Strong beat. Revenue was also a strong beat, and pretty much had growth on most of their divisions, showing strong growth in the equity sales, global management. Their fixed income sales and trading rev was down though, 1.64 to 1.95 billion last year, but the investment management income was up as well. So all of these numbers, by the way, are taken from Trading News. So as well as some of the information from the actual PR from the companies. But so it's been another good earnings for Morgan Stanley. And again, they, I think initially we actually had a bit of weakness from the number, but pretty much the same as every other bank. Any weakness was met by buying, and we moved up. And we moved up from a low of just below 98, and we closed at 102. And let's just see where we closed today. Morgan Stanley, went down about 7/10, so closed out just over 101.40 today. So it was strong earnings there by pretty much most of the banks, which started the ball rolling quite well in this earnings season. Looking ahead now, we are gonna, we've got a lot of earnings coming up. It's going to be coming up thick and fast. We're going to have Jason. It's going to talk about and preview the upcoming Tesla earnings, which is Wednesday after the close. Tomorrow after the close, we actually have Netflix, and one of the first FANG names to report, and they've had a monster run. So it'll be interesting to see what Netflix say. Their Squid Games has been pretty much a catalyst, helping propel the stock to just around an all-time high. They're saying the Squid Game franchise is worth 900 million in a report through an initial investment of 21 million. So it's been huge for Netflix's Squid Game. So it'll be interesting to see what they say about that in their earnings and their call. But I think Netflix have to sort of deliver the numbers and provide some good guidance, because we've had a really good run up, trading well above 600. And so we'll see what happens with Netflix. Tesla's obviously another one that's had a big run up, gone from like 770, ended the day at 870, I think, around today. So another one that's going to be pretty good. So I'll pass it over to Jason now to see for him to give you his analysis on Tesla's upcoming earnings and anything else he has.
Thanks, Rajan. So I've been going all in on Tesla stock since around 2018, and it's by far my highest conviction play in the market. As I've stated publicly on Twitter, I believe that if Tesla continue to execute, they'll become the largest tech company in the world by market cap. So earnings for Tesla are always highly anticipated, and despite all the legacy automakers complaining of supply chain disruptions, Tesla made an amazing 241,300 deliveries in Q3, beating analyst forecasts. We can already see a large run up in the stock price into the 870s. This is also going to be potentially the first earnings call where Elon actually isn't present. This is quite bullish in my point of view. As you know, Tesla is Elon's baby, and Elon letting go means, in his mind at least, things are going in the right trajectory, and that is a great thing for our shareholders. So we can plug in our delivery estimates into our forecast and see a great 73% year-over-year growth in Q3. If we navigate into our delivery model breakdown and revenues, we can see that we've calculated an average selling price based on our estimated delivery share of Model 3, Y, and X in Fremont and Shanghai. We've updated some of the Fremont pricing because it's been steadily increasing in Q3, likely because of supply chain costs increasing and potentially the Biden EV tax credit, which may be decided at the end of the year. Either way, Tesla is sold out until next year on all models from Fremont. We've estimated take rates as 22, 25, and 40% of Model S Plaid owners will opt for FSD as they're early adopters, and the FSD to vehicle purchase price percentage is much lower than with other models. From Shanghai, we have much lower FSD take rates, gives us an estimated $11.889 billion in revenue. Now, if we go to our financial estimates, we can add the $300 million in regulatory credits to the automotive revenues on the previous page to get $12.189 billion in automotive revenues. People are always going to bag about Tesla using regulatory credits being the only reason that they're profitable in some of the previous quarters, but tell me any other company in their right mind that wouldn't take advantage of these credits if they invested so heavily in EVs. The legacy automakers were given the same amount of notice as Tesla that these credits will be in effect, but they chose to sit on their hands, so they had to pay up. It's plain and simple. The fossil fuel industry gets a huge amount of subsidies and favorable tax advantages too. So don't hate the player, hate the game. The regulatory credit advantage that Tesla has won't last forever, but by the time it does go, Tesla will be so profitable it won't even matter. A year ago, regulatory credits were 50% of Tesla's operating income. Now it's less than 20%. Automotive gross profit up 68% to $3.5 billion, and with estimated 29% gross margins. Energy generation and storage at $750 million, and just shy of $1 billion on services and miscellaneous, which gives us total revenues of $14.238 billion. Cost of revenues we've estimated at $10.347 billion. So we estimate a total gross profit of $3.891 billion with a total GAAP gross margin of 27.33%. We've estimated similar R&D and SG&A, but we have no impairments for Bitcoin as the price didn't hit a new low. So I've got operating expenses at $1.54 billion and income from operations at $2.351 billion with an operating margin of 16.52%. And we've got stock-based compensation at $450 million. So we've got GAAP net income of $2.038 billion and non-GAAP net income of $2.488 billion, which is 185% year over year. So in terms of earnings per share, we've got $1.82 compared to analysts at $1.60. That gives us a PE of 251 and a forward PE of 119. So Tesla has become an absolute beast. In Q2, we had adjusted EBITDA of about 2.4 billion. In Q3, I think we can get to about 3.5 billion. The run rate of about 14 billion, if we do a 60 times multiple for growth companies such as Tesla, that's around 840 billion, which is more or less of where it currently is trading at. However, in the short term, after earnings, I see a potential small stock price dip. Why? Because the delivery numbers are already out and people can extrapolate pretty easily what earnings are likely to be. And now these earnings are pretty much priced in. Traders may take profits once the earnings are announced. However, I'm a hodler, and in my opinion, the 40+% CAGR that Tesla is currently achieving and set to continue to achieve, it deserves a multiple of 80. Which is a stock price target of around 1150 to 1200 in the next 9 to 18 months. But there's a chance it could come earlier. There's a number of Tesla tubers and Tesla Twitter users where you can get some great info from, and also where part of this information was crowdsourced. Links to a few profiles are in the description. So there's some upcoming catalysts for Tesla stock. The one that excites me the most, but it seems to be the most elusive, is the Tesla FSD beta expansion. Currently, it's around 2,000 to 3,000 users, with the newest entrants having 100 out of 100 in their Tesla safety scores. Be interesting to see how Tesla's vision-only approach performs once we get to 15,000 and more users concurrently using the system. And they'll be testing in new locations and new scenarios. Potential concerns are if there are any kind of accidents, and also if there are long lag times between updates, which could signal some kind of changes in approach. There's nothing wrong with this, but the timelines will continue to drag, which might worry some. But this is actually one of the hardest AI problems currently in existence. The march of nines to getting as good as human drivers is exceptionally hard, but if any company can do it, it's Tesla. So we have Austin and Berlin opening up by the end of the year. We have Biden's EV tax credit, which is great for the whole EV industry. Next year, we have Tesla becoming potentially investment grade, so more funds can invest, which is a great thing. This is crucial in terms of the 4680 batteries scale up in production. Many of the future vehicles depend on this, so it's actually crucial for Tesla to get this right. If they do, we'll see great new product launches like the Cybertruck in the second half of 2022. And then in 2023, we should see the Roadster and the Semi. I'm waiting for that Semi because it will change the trucking industry. And the last thing is the Tesla Q compact vehicle, which is supposedly around $25,000. But I wonder what the cost of that will be with inflation. So that about wraps it up from Rajan and I. Please like and subscribe. It means a lot to us. We'll see you in the next one. Thank you.